Let's talk about China's changing domestic economic narrative. Those who follow the Chinese economy closely understand the significance of the economic reform blueprint first released by Xi Jinping's administration in November of 2013. This came earlier in his period in office, in fact, very early. After a fierce internal debate back then in the preparation of the document, agreement was finally reached on its central organising principle, that, and I quote, "the market play the decisive role in resource allocation." Big decision, big debate, big conclusion. The decision also incorporated 60 different reform measures covering 10 broad categories of trade, cross-border investment, state-owned enterprise reform, competition policy reform, financial system reform, fiscal policy, innovation policy, labour, environment and land reform. This was a conscious effort by China's economic leadership at the time to transform China's historical economic growth model over the previous 35 years to what became then universally known as the new model, 新的经济模式. The old model, as we are all familiar, was based on two pillars. First, labour-intensive, low-cost manufacturing for export, reinforced second by high levels of public investment in national economic infrastructure. The new model was based on three pillars: high levels of domestic consumption, private sector-driven innovation, following the completion of the SOE-driven infrastructure build, and third, a sustainable development revolution, green energy, renewable energy, energy efficiency, and the whole kit and caboodle. Implementation began in 2014-15, but the party's confidence in the market was dealt a body blow by the implosion of Chinese equity markets and broader financial markets in August of 15. From that time on, as we at the Asia Society Policy Institute have tracked through our China Economic Dashboard, the pace of implementation of the reform program slowed dramatically and in most areas ground to a complete halt. Harsh capital controls were also imposed on China's capital account, making it much more difficult for private firms to expand their operations abroad. At the same time, because of legitimate fears about the size of China's debt-to-GDP ratio, driven in large part by an out-of-control shadow banking sector, as well as ballooning local government debt, the central government began a national deleveraging campaign, which over the last several years has also resulted in credit being withdrawn indiscriminately, sometimes bureaucratically, from otherwise profitable private Chinese firms. At the same time, Chinese SOEs have been given a new lease of life, where the national deleveraging campaign has had less effect on SOEs than their private sector counterparts. Furthermore, there has been the rolling impact of China's anti-corruption campaigns, Fan Fu Bai. It has fundamentally slowed government decision-making processes, as officials, perhaps naturally, have sought to protect themselves from political exposure by not making decisions, which meant that the private sector development projects long in the pipeline have begun to slow significantly. To this was added Xi Jinping's emphasis on the central role of the party, the primacy of ideology, resulting in an enhanced role for party secretaries operating within private firms. And on top of all the above, there's been considerable confusion as to the precise implications of China's so-called mixed ownership model, whether it was an invitation for private firms to absorb poorly performing public trading enterprises, or whether in fact it was creating a fresh opportunity for SOEs to nationalise well-performing private firms. We've seen both. All these factors have been unfolding across the Chinese economy over several years prior to the beginning of the U.S. China trade dispute in the first half of 2018.